Corporate accounting operates in two distinct realms: financial accounting for external reporting and management accounting for internal leadership. Financial accounting is strictly historical. Bound by GAAP, its primary function is to report on past performance for stakeholders. Management accounting looks forward. It is designed to improve organizational decision-making by analyzing how costs will affect future operations. Cost accounting is the engine beneath both disciplines, measuring exactly how resources are consumed to support both external compliance and internal strategy. To an internal accountant, the word cost by itself is meaningless. A raw dollar amount only becomes operational when it is modified by a term defining its specific purpose, like an incremental or fixed cost. Without a strict taxonomy to classify how money behaves, raw expenditures cannot be translated into actionable strategic decisions or compliant external reports. To understand cost behavior, we have to look at how different types of labor are categorized within a corporate hierarchy. This assessment question requires us to identify which of these specific roles qualify as direct labor costs. We have three distinct positions to classify: machine operators, factory supervisors, and a corporate vice president. Misclassifying these wages distorts how inventory is valued on the balance sheet, leading to inaccurate financial reporting. The options follow a strict yes-no matrix. There is no room for ambiguity in professional compliance. To find the solution, we need to build a definitive, ground-up model of how costs are actually allocated. The starting point of this model is the cost object, simply the target, like a product, a process, or a department, to which a cost is attached. Once defined, we apply the filter of traceability, dividing expenditures into direct and indirect costs. Direct costs are inputs practically traceable to the cost object. Indirect costs are expenditures that cannot be easily associated with a single object. To handle these untraceable costs, accountants use a mechanism called a cost pool. The cost pool accumulates similar indirect elements that share a common cause, such as factory utilities or maintenance. From there, a cost driver acts as the metric used to assign those pooled costs back to the object. Common drivers include machine hours or direct labor hours, metrics reflecting actual resource consumption. This traceability matrix ensures that indirect common costs are allocated using a systematic and rational basis rather than an arbitrary estimate. After determining traceability, a cost must be categorized by its operational function. This divides corporate spending into two distinct environments: manufacturing and non-manufacturing. Within manufacturing, the first input is direct materials. These are the tangible physical inputs that can be practically traced into the final product. The second input is direct labor, the cost of human work required to assemble the product. The third category is manufacturing overhead, which includes every factory-related cost that isn't direct material or direct labor. Outside the factory floor, we find non-manufacturing costs. Selling expenses cover the costs of moving the product to the consumer, such as marketing and transportation. Administrative expenses are corporate costs unrelated to production, such as executive salaries or headquarters rent. The physical boundary between the factory and the corporate office dictates how these expenses are treated on the books. Management often groups these manufacturing costs into specific formulas to analyze efficiency. The first grouping is the prime cost, the primary expenditures directly attributable to creating a product. The second grouping is the conversion cost. This represents the resources required to convert raw materials into a finished state. By separating these costs, executives can isolate material waste from labor and overhead inefficiencies. The ultimate purpose of this taxonomy is to determine when an expenditure is officially recognized as an expense. Product costs, or inventoriable costs, include direct materials, labor, and overhead. These are capitalized as assets in inventory and only become an expense when the product is sold. Non-manufacturing costs are treated as period costs. These are expensed immediately as they are incurred, bypassing the inventory account entirely. Misclassifying a period cost as a product cost artificially inflates immediate profitability by hiding current expenses on the balance sheet. Applying these rules to the initial question allows us to classify each role with precision. Machine operators physically assemble the product, making their wages directly traceable. They are direct labor. Because they are direct labor, they are a product cost. The classification is yes. Factory supervisors work in the plant, but their oversight is an indirect cost that cannot be traced to a single unit. They fall under manufacturing overhead, meaning they are not direct labor. The classification is no. The corporate vice president operates outside the factory environment entirely. This salary is an administrative period cost. It is excluded from both manufacturing and direct labor. The classification is no. This sequence confirms that option B, yes, no, no, is the only functionally sound answer. By maintaining these strict boundaries of traceability and timing, financial professionals transform raw data into a reliable map of corporate health.